All right, welcome to today's webinar, Index Universal Life, the Napkin Sale. My name is Brian Lysing. I'm one of the life insurance sales directors here at Financial Brokerage. We are a national marketing organization based in Omaha, Nebraska, but working with advisors and agents all across the country with life insurance, annuities, long-term care, critical illness, disability income insurance, Medicare supplements. I've probably forgotten something along the way there, but between myself and my counterparts here, we can help you with just about all of your clients' fixed insurance needs. And for those of you who are already familiar with us and already doing business with us, we would like to thank you very much and thank you for your time this morning here to everybody. This morning's webinar comes to us from our friends at AIG, one of the roughly 25 life insurance companies that we work with here. And they said, hey, we've got some slides that we think would work well for a webinar. Go ahead, feel free to use them. So these are meant for, this presentation is meant for producer use only, not for consumer use. So if you ask for a copy of the slides, it's really not for a client presentation. I do have a piece I can get to you after the webinar, though, that will go over some of these concepts that we discussed this morning. But basically, we're going to have a conversation here about retirement planning using a life insurance policy, and in particular, the tax advantages that that gives to your clients. And this is really all part of our month of June life insurance sales challenge here at Financial Brokerage. For those of you that have done business with us in the past, you know that we host incentive trips every year, and you can earn credits or what we call success shares towards those trips for every piece of business that you place in force, every product line. So in the month of June, we are offering double success shares for folks who sign up for this life insurance sales challenge for all index universal life business and a couple of select whole life products that we work with. You may have seen some webinars already and certainly some sales ideas talking about the unique tax advantages of income coming out of a life insurance policy while the insured is still living, and that's a big part of what this morning's webinar is going to focus on. Speaking of today's focus, I already alluded to the fact we're going to be talking about helping your clients diversify the income taxes that they'll have to pay on their retirement savings, or maybe eliminate some of those. And we're going to go through really the three phases of retirement planning, the contribution phase, the accumulation phase, and then finally the distribution phase, and that's where life insurance comes into play primarily. Also that you can help your high income earning clients and prospects, help them with a powerful supplemental retirement solution. I just mentioned high income earning. Our target market is going to be high income earners. If you have a client who wants to sock away $50 a month or even $100 a month into a retirement plan, it's probably not going to work very well with this concept we're going to be discussing. I'd say your targets are people who are maybe maxing out a Roth IRA. They're putting in $5,500 a year into one of those, or they're maxing out their 401k. They're already putting in 18 grand a year, and they'd like to put more money somewhere, or somewhere along those lines at those levels or higher. That's really what we're looking at, and where these products can really shine and help out your clients. You know, these folks are typically looking for some tax advantages as well. They might be business owners, certainly higher income earning folks out there. And then the age range, you know, we're probably looking age 35 to 50. You can go a little bit above 50, but what happens there is we really don't have enough time to accumulate the money to then distribute later on in life. And under age 35, typically we don't see folks with the income and the cash flow to properly fund one of these. So you can find folks outside of this range, but that 15-year time period is going to be where the bulk of your prospects are going to be found. All right, so let's get into what AIG calls the napkin sale. I would call it that too. This is something that you can use with a scrap piece of paper lying around somewhere, sticky note, a napkin, and this, you could even scratch this little idea in the dirt or the sand, wherever. And it's meant to be a very easy conversation to have with folks. You don't have to walk into a meeting with a briefcase or bring out the laptop or an iPad or present a slideshow. It's meant to be a real simple little sales idea and a discussion you can have with just about anybody. And the discussion is basically going to go, well, what we're going to get to is letting our clients know that, look, every dollar you put towards your retirement plan is going to go through three phases, right? The contribution phase, that's where you put your money in. The accumulation phase, that's where you grow it. And then the distribution phase, that's where you take the money out. And regarding those three phases, you know, we've got good news and bad news for you. Bad news is the IRS is going to come in and say, you know what, you need to pay taxes on at least one of those three phases. We've got some good news too. Good news is you get to decide which one. And it all depends on the vehicles that you choose. So how do we start this conversation with our client? Because right now it's a little bit complicated. I said something you can scratch on any piece of paper, a napkin, or what have you. So here's what we're going to do. Get the conversation started. All you have to do is write $3 figures on the corner of this piece of paper. And then tell your client, your prospect, this represents your retirement plan. Then you go on to tell them what we've discussed on the previous slide, that every dollar of your retirement money goes through three phases. There's the contribution phase, the accumulation phase, and the distribution phase. And for purposes of our conversation, we're going to represent the contribution phase with $5, the accumulation phase with $10, and the distribution phase with $20. Now, as it pertains to these three phases, we've got the good news and the bad news, right? You've just heard this a couple seconds ago. The bad news is Uncle Sam says you're going to have to pay taxes on at least one of these three phases. Good news is Uncle Sam doesn't care which one you pay taxes on. You get to choose. It's completely up to you. Which one of those would you choose to pay taxes on? If it's up to you, and it is up to you because Uncle Sam has said it is. So then you hand the pen over to your client or prospect, ask them to circle the one they would prefer to pay taxes on. And in every case, they're going to circle the $5. I mean, who wouldn't, right? Who wants to pay taxes on the 10 or the 20 if you could pay taxes on the $5? Well, then you need to ask them, where are the bulk of your retirement assets currently invested? And I bet you for a lot of folks they're going to say it's in their 401k or it's in their IRA. Well, you know what that means. They got a deduction up front. They're going to have to pay taxes on the back end. So even though they would prefer to be taxed on the $5, their current plan has them paying taxes on the $20 figure. And most folks have no idea that that's what they're up against. And again, I love this idea. It makes it so simple for people to see with just $3 figures there. You don't have to confuse them with a whole lot of jargon necessarily. But then you want to ask your client or prospect, look, wouldn't it make sense to diversify at least a portion of your retirement money into some other vehicle where you would actually pay taxes on the $5 and not the $20 figure? And of course they're going to say yes. So what if you had access to a retirement strategy that provided you with the tax treatment you want and you could put in as much money as you want? How much money would you put into a plan like that every year? Ask them that question, get the premium commitment. And, you know, in the infomercials, there's always a but wait, there's more part to the conversation, right? Well, but wait, there's more. So not only do you get the tax treatment that you would prefer, and what we're really talking about here is putting money into a life insurance policy. There's some additional benefits that come with that. One, the plan is self-completing at the owner's death. Well, what in the world does that mean, self-completing? Well, if we have that 35-year-old that we saw earlier, the person is intending to put away, let's say, $15 grand a year into this plan until he or she turns age 67. Well, what if they live 5 years and they're killed in a car accident, but their spouse was depending upon that money being put away every year for retirement? Well, guess what? There's a death benefit that comes with this. This will probably fund the remainder of those years of contributions that now are no longer going to happen. So the plan is self-completing at the owner's death. That's a nice little advantage you're not going to see with any other retirement plan out there. Your 401k, your Roth plans, you have to actually keep putting the money in. Your plan administrator isn't going to put in the dollars if you pass away early. It's just not going to happen. We also don't have to worry about a set limit on contributions with the life insurance policy. Again, if you compare this to other options that are out there, if a person wants to put money into a Roth IRA, which has the same tax treatment we're talking about here, well, you've got limits on how much. You can only put aside $5,500 a year, a little bit more if you're older, but $5,500 a year into your Roth IRA. And incidentally, if you have a husband and wife and their joint income exceeds $194,000, they can't contribute anything to the Roth IRA. So life insurance doesn't have those restrictions. Some other restrictions out there are 401k plan, $18,000 a year. And you're going to see an example of a person who would like to put aside more than $18,000 a year into his retirement plan, but he's up against those maximums. Now, there's also a SEP plan some people can do, and the maximum for that is $53,000 a year. Again, if they want to set aside more, you're going to have to look elsewhere, and then you don't have the tax advantages on top of that. Pre-59.5 access. What does that mean? Well, we know with qualified money that in most circumstances, if you take the money prior to age 59.5, you're going to pay an extra 10% penalty tax. Now, there are some ways to get that out, but you have to follow a specific set of rules, and you can't get all the money out. You can get a part of it out. And there are even some restrictions on Roth plans and how long the money has to be in there and that sort of a thing. What about catching up missed contributions? If you're contributing to an IRA or a Roth IRA and maybe one year you don't put in your $5,500, you put in nothing, can you double that figure the following tax year? No, you can't. The government won't let you. You can't make up past contributions if you're below the limit in one particular year. Well, you can do that with a life insurance policy. You can catch up on missed contributions if your situation changes for a period of time. And now on the back end, on the distribution side of things, taking money out of a life insurance policy, you don't have to worry about required minimum distributions. When you hit age 70.5, no one is going to require you to take a specific amount of money out of that policy. If you have other resources to live on, that's fantastic. You can just leave the life insurance money intact. In fact, one strategy people will use is to pull money out of the life insurance policy during a down market so that they're not selling off of their portfolio at a loss. It's another strategy a person might use, and you're not going to be dipping into it every year if you're doing that. And also no required minimum distributions for the beneficiaries. If you have qualified money, somebody's going to pay taxes on it sometime. You can stretch it all you want, but someone is still going to have to pay taxes on it. We don't have to worry about that here at all. The death benefit is going to pass 100% tax-free to the beneficiaries. All right, so let's put this example in action with a example. And here we've got a chiropractor by the name of Darren. He's 40 years old. He's in great health. He's making $400,000 a year, and Darren would like to retire at age 67. That's what's considered, quote, his full retirement age for Social Security benefits. Now, Darren, he's enjoying his career as a chiropractor. He's helping folks out like myself that run into back problems every now and then. And he really sees no reason to stop working prior to age 67. Darren's done a good job of saving. He's always maximized his 401k contributions that he created, the 401k plan for himself and his employees at the office there. But he's always targeted setting aside 10% of his annual income. Now, that would be $40,000 a year. Now, we learned a little bit ago that Darren can't do that. I mean, he can only put 18 grand into his 401k. So that leaves another 22 grand that he'd like to set aside, but he can't. The government says we won't let you. Well, what can we do to help out Darren a little bit here? Well, one of the things we can do is ask Darren to put some of his money into an index universal life policy. And here's how we generally structure these. Since we're not focusing on the death benefit, but more on the accumulation and distribution, we're going to start with the money that Darren would like to set aside. In this case, the 22 grand a year, and we're going to solve for the smallest death benefit possible, because we want to keep the cost of insurance down as much as we possibly can. And one way to do that, it might seem counterintuitive, but we're going to actually start out with an increasing death benefit option. That's going to let us put as much cash as possible into the smallest death benefit possible. And we're going to leave it at an increasing death benefit option during the entire contribution phase. That means that Darren's death benefit will be $550,000 plus the value of the cash inside the contract. And as the cash grows, the death benefit will grow along with it. Now, once we get to the distribution phase, we don't need that increasing death benefit, because the cost of insurance at those older ages is really going to hurt us. So we can switch it to a level death benefit, and we'll stop that death benefit growth. So that's the structure behind the contract. Now, what is that going to give Darren? Let's take a look here. We're going to through age 67. We're going to begin withdrawals and loans for 20 years at age 68. And we're still going to have a policy in force, because the policy does have to remain in force, and most of the carriers have some safeguards built into these products to make sure that they don't lapse. If a policy would happen to lapse, then all the growth that a person has taken out of that policy becomes taxable in the year the policy lapses. You don't want that to happen. So what happens in Darren's situation here based on those assumptions? Well, look, these numbers look a lot like those original three numbers we sketched on the napkin, the $5, the $10, and the $20, right? Over his lifetime, he contributes $594,000 to the policy. It accumulates to $1.3 million. And if we do some rounding here, we get the $5, we get the $10 with a bunch of zeros after it. And over that 20-year time span, Darren pulls out over $2 million out of his policy. Now that looks a lot like, the example we had and earlier on. All right, so we've gone through the three figures you can sketch on a piece of paper. We've gone through an example applying this to a real-life situation, and now I just want to recap, if the PowerPoint will catch up to me here, the additional benefits of using a life insurance policy. So we talked about the income tax-free death benefit. We mentioned the fact that there's no IRS-defined limitations on the premiums going into one of these policies. If somebody would like to put in more than what they're putting into a 401k or a Roth IRA, they certainly can. There's no limits on how much income a person can make and still contribute to one of these policies. If you miss a premium, you can make it up later on. That's fine. You can't do that with an IRA or a Roth IRA or even your 401k. The money accumulates tax deferred. You're not going to get hit by the IRS every year. And in fact, if you take distributions correctly, using withdrawals and loans or just loans, sometimes that works better. The money you're getting off of that plan is 100% income tax free. You can retire early. The example there of Darren, hey, he loved his job, wanted to keep working. That's fine. But what if you have someone who, instead of retiring at 67, wants to retire at 57? Well, you know what? If they've got enough money in the policy, they can do that. They can access as much or as little as they want. You can use the money for other reasons too. I mean, I do some webinars here with similar examples with college funding in mind. So maybe the person's 50 years old, kids are going to college, and they want to access that money out of the life insurance policy, you can. There's no tax consequences to doing so. Maybe they want to buy a new car, buy a new house, whatever. You don't have the restrictions you'd have with other retirement plans. And of course, when you get to that distribution phase, you don't have to worry about required minimum distributions. It's up to the client to choose when and how much they take out a policy. And we are still talking about life insurance policy here, so there is a death benefit, and this plan becomes self-completing upon the death of the insured, and that death benefit will always exceed the actual account value. So I'd like to thank everybody for joining us this morning. At this point, I'll open it up to questions. You can type them at the bottom of the control panel on your right. And also, I almost forgot to mention this. When I told AIG we'd be hosting this webinar and actually another one in a couple of weeks, they sent us a whole box full of giveaways. And what we're going to do for those is draw names. I'll get the list of all the attendees from this morning. And they've got some nice things, some golf shirts and some golf balls. So we'll draw names for those, and I'll give you a call. And they've got some other items as well. So we're going to make sure that everybody gets something, but we'll probably have to draw names for some of those items there. So at this point, let's see if there's some questions out there.